Today, more housing debt records are broken. Hello again, it's Martin North from Digital Finance Analytics, where it is post covering finance and problem news with a distinctively Australian flavour. It's the last day of January today, and so of course we get the latest information relating to credit from both APRA and the RBA, and I'm going to walk you through that now. So we'll start with the financial aggregates from the RBA first. Remember, this is the total amount of credit washing around the system. And they said that in the year to December 2021, housing credit rose by 7.4% compared with 3.5% last year. Personal credit dropped by 3.8% over the 12 months compared with 12.5% this time last year. And business credit was up 8.4% compared with 0.8% a year ago. And in the month, housing credit was up 0.7%, business lending was down 0.08%, business credit was up 1.1%, and broad money was at 1.5%. And total credit for the month was 0.8%, and for the year it was 7.2% overall. So a fairly strong outturn there. Now, if we then look at it in more detail, this is the monthly movement. So housing credit was up 0.71% over the last month. Owner-occupied credit was up 0.82%. Investment lending was still growing, up 0.47%, but is considerably lower than owner-occupation lending. Personal credit was down 0.84% over the month, and business was up 1.12%. And looking at the aggregate numbers, overall credit grew by 0.78%, whilst broad money was up 1.48%. It's worth noting that overall credit, up 0.78%, was slightly lower than last month. If we then look at the annualised story, that's where some of the monthly movements are taken out of play. Essentially, housing is up 7.4% overall. Owner occupation is up 9.57%, and that is the highest, in fact, for about 12 years. So it's very, very strong. Investment lending was up 3.4%. Personal credit was down 3.83% over the year. And business was up 8.4% over the last 12 months, so pretty strong. And the overall credit growth is up 7.18% over the last year, and broad money is up 9.51%. So it is worth just reflecting on that. We see that credit is still very strong, money supply is even stronger, but of course a lot of that is driven by ever more housing credit. And I guess you can ask yourself the question as to whether that is healthy or not. If we then look at the APRA numbers, so this is the APRA statistics for the banks, and it again is looking at the total balances outstanding. So that's new loans on, less loans repaid, and of course includes refinancing as well. And if we look at the change over the month, owner-occupied lending rose by 1.03%, which is a very strong read. Investment lending was up 0.59%, again quite strong. And overall credit was up 0.88%. So you can see there at the top of the range. Overall lending stock is a record at $1.93 trillion. We're knocking on the door now of $2 trillion. We've never seen that amount of money thrown at housing. And interestingly, within the mix, investment lending is still shrinking as a proportion. It's down to 34.07%, but that is still a very large proportion. But it's worth reflecting on this. In the UK, the Bank of England was extremely worried when the share of investment lending reached 16%, and we're double that in Australia. Well, good old investors, I say. And then if we look at the individual portfolio movements from November to December. That tells quite an interesting story with National Australia Bank right at the top there. There's a reason for that, and that's because of now 86400 is now incorporated in the NAB numbers. Westpac was down on the investment side. Commonwealth and Macquarie were lending strongly. And then the smaller lenders were also into action as well. And interestingly, though, one of the big four is missing in that top group. The ANZ is actually right over there. And it's interesting that they are losing owner-occupied share, slightly making progress on the investor side. So ANZ is steering a completely different course. And of course, they did say recently that they recognised that they had underperformed in terms of the mortgage sector of their business, and we're going to try and address it. Well, we'll see whether they manage to or whether they don't. But standing back, what you can see here is that credit is very, very strong. It's probably way too strong. And that could be one reason why we might expect to see interest rates moving up a little sharpish ahead of time. Although most of the commentators are still of the view that the RBA will do nothing this year and might actually do something late next year. Some of the major banks are bringing that forward. Westpac, for example, suggests that maybe it will be August this year. But what we can see is that the economy is definitely being messed over by the very severe lending to property. It's not healthy, it's not good. And it's worth reflecting that now we've got twice as much lending to housing as we have to business. If you go back a couple of decades, the reverse is true. And I would remind you again that many people are on variable rate loans. And if mortgage rates do start to rise, then tears will follow quite soon. Once again, the regulators are off the pace. The RBA is, I think, in deep water and doesn't quite know what to do. So it'll be interesting to see what they say tomorrow on Tuesday when they make their announcement after their meeting. Probably not a lot. And also what happens subsequent. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.